you don't know where to begin, better ask Win.
Shane, so good to see you. Let's talk through 76 years of headlines, what market history teaches us about staying invested. From oil embargoes to global pandemics, the S&P 500 has endured decades of volatility and come out stronger over time. So let's break down the data and talk through whether pre and post retirees should make any changes to their portfolio. And I wanted to do that in light of this chart. What stands out to you here about how the market responds to global events?
Well, the biggest thing that really stands out to me here is that, yes, of course, global events do affect the market. But if we kind of step back, this line is always going up at a pretty good angle. It's always heading in the right direction. And if we try to time these global events and try to jump in and jump out in and around global events, that becomes a very difficult thing to do. And that's basically what we come to when we try to time the market. We always say that time in the market is so much more important than timing the market. And if you're planning for long-term growth, the best way to grow is to stay invested and not to try to jump in and out depending on news cycles and global events that are happening around you.
Right. Zooming out, it's clear that staying the course, staying invested is often the best advice. But if I feel uncomfortable about how I'm invested, when is the right time to make changes to my portfolio?
Well, I think if you feel uncomfortable, it might already be a red flag that now is the time to make that change, right?
Yeah.
Don't try to time it with some global event. Don't try to, work it into the dates of the calendar, but sit down, assess your risk profile. That's something that we like to do at least every year. Make sure that we know how much risk you're comfortable taking and modify the investments if they're not exactly to your liking.
Mm-hmm. And how does that answer change for someone who is nearing retirement or recently retired?
Well, it does change quite a bit because we want to make sure that those people who are just into retirement are taking income and withdrawals from the right places and that they're not over exposing themselves to risk. And most people will recognize that their risk tolerance does start to drop rather significantly as they approach and enter into retirement. So as we enter retirement, we're going to want to tone back our risk, pay even more attention to how much risk we're taking, and really start to structure potentially buckets for protection and growth and make sure it's all working together.
Mm-hmm. And of course, we can't have this conversation without talking about sequence risk. For people who retire, when they recently retire into a down market, that presents a really unique challenge. Can you explain this one, please?
Yeah, sequence of returns is one of my favorite topics. And it's really all about when it's your turn to retire, what's the market going to do? And if it's not doing something that you like, what are you going to do about it? So this chart is really a great example. And I do something very similar in many of the classes that I teach, where we talked about two retirees that start with the same amount of money, but end up with very different amounts at the end. They had the same average return during that time period as well. How is their result so different at the end? And it has to do with when the downturn came or when that sequence of events happens in their timeline. And so it really, really matters. But the best way, or one of the best ways, in my opinion, to defend yourself against sequence of returns risk is to provide separate buckets, some for safety, some for income, and some, most importantly, for growth. And when we have a bucket that's designed just for growth, then we do two very important things in that growth bucket. First of all, we buy time in the market, which allows the market to be the market, allows us to accept some volatility, to go for some growth, but it also avoids that growth money being forced into what I believe is one of the worst situations you can find yourself in, which is being a forced seller in a down market. And if we can avoid being a forced seller in a down market, then we kind of alleviate this concern of sequence of returns because we've given this money time to grow. We're not asking it to do double duty for income and protection. It's solely there for growth. Our income and our protection is handled elsewhere. And segmenting like that is really a core baseline process that we talked about so much here.
Right. And again, that third bucket comes back to what you were saying at the very beginning, having money and letting it have time to grow, to go with, ride through that volatility, also so important. So Shane, if somebody would like to talk to you, if they're feeling uncomfortable about these headlines or how they're invested, what's the best way to reach you?
Best way to reach us is online or via phone. You can check out our website, winstonandcompanies.com, or call us here on the phone, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask Win.